I understand you have a mortgage. I understand that you have other bills. Do not commingle these things. You have to be able to look at your company and your financials on their own and the bank account. If you have a restaurant and are not depositing the draw into your own personal account and then paying your mortgage, that's a problem. You have to have that definitive line in the sand.
You should have a checking account for your business, you're saying?
Yeah.
Or have a personal one. You know, like you need two.
Yeah, I got you.
This is Restauranttopia.
Welcome back to Restauranttopia. We are here with Brian Seitz.
Dave, how you doing?
I'm doing fantastic. Anthony Hamilton.
How you doing, man?
The cook. Anthony Hamilton.
The cook.
For all you insiders, throwback to episode 1.
Mm-hmm.
And Dave Ross. And we're here. Brian's got a great episode about the 6 financial mistakes that is killing your restaurant. And he's going to tell you how to fix them.
This is important to everybody out there because the industry has gotten more difficult. And we just had that episode with Jamie Romano from J&R Accounting talking about the big, beautiful bill. He even said it, and he sees way more restaurants than I do. The game got harder.
Mm-hmm.
And there's some simple things that you can do that I think are so critical that can make or break you. And these 6 things are financial mistakes that could put you out of business. So I want to talk about them, tell you how to fix them, and make your financial life so much better.
Okay, I love it.
All right. Number 1, biggest mistake, mixing business and personal finances. I gotta say this. I understand you have a mortgage. I understand that you have other bills. Do not commingle these things. You have to be able to look at your company and your financials on their own and the bank account. If you have a restaurant and are not depositing the draw into your own personal account and then paying your mortgage, that's a problem. You have to have that definitive line in the sand.
You should have a checking account for your business, you're saying?
Yeah.
Or have a personal one. You know, like you need two.
Yeah, I got you.
Listen,
Yeah,
I've seen a lot in this industry in the independent world. And how many times the ownership or whoever goes on a really elaborate, lavish vacation and then comes back talking about how we need to trim labor to make payroll.
Yeah.
That's tough.
Yeah.
That's a tough pill to swallow.
It is tough. And
but I think this is even more specific. Like, did they pay for the vacation out of the business checking account?
I know.
of course they do.
Of
course they do.
You've seen it just like I have in acquisitions. When you get a hold of P&Ls and you're looking to buy a business and you're very excited about the notion, but it's such a tangled web of personal and business that it's like, we have to wait a year. You got to undo this. And
that's an interesting point because that's actually what I deal with all day long.
Mm-hmm.
And that in the industry is called an add back. The new driveway you put in at your home for $25,000, you're like, oh, that wasn't for the restaurant. I know I told the IRS that, but that was for my business. And it's like, okay, like how many other things am I going to add back where you allegedly made this money?
Yeah, and essentially what you did was you avoided taxes, you avoided all those things, you did all this stuff to try to like eke everything out of the business, and then you can't sell it.
Correct.
Because
you have to tell a story with your financials.
Right.
And like financials are supposed to speak for themselves.
It's just so much easier being above water.
I saw something on a P&L. You've probably seen crazy things, but I saw this. It literally, like, you're going down the P&L, and one line said, "Ask accountant."
Yeah.
And then they had dollar numbers in it that were quite large. It was like, what is that?
The bullet point under, I plead the fifth.
Yeah.
I had a deal the other day, and we're going over looking at buying. It's a food manufacturer, and it was a really nice guy. He's telling me all these ad backs. It ended up being, I'm not shitting you, $2 million for
that. Out of here.
$2 million on a like a $10 million business.
Yeah.
And I'm like, none of those are ad backs. And actually, I appreciate you bringing them up because I think some of them are actually, I'm gonna have to spend more money than you're spending.
Yeah.
And I was like, dude, like, and it was like you could just see the oxygen,
the blood
like,
drain out of his face.
Yeah, it's just like come out of the room. He's like, oh, it's like, he's like, I disliked you at the beginning. Now I'm confirmed. You just confirmed it.
It reminds me of the skit where the guy's like, we just write it off. He goes, what do you mean write it off?
We write it off.
What do you write it off to? I don't know. You just write it off. He's like, where do you send it? He's like, the write-off people.
It's a write-off. It's a write-off. Number 2, this is so important. And I know we've done the episodes on merchant cash advances and the loans, but do not get yourself in debt. Growing with debt instead of cash is a killer. Think about what you're going to get a big loan for, or you're going to get financing, or you're going to bring on this partner for that. It's a debt equity deal. Be very, very careful. Debt is an addiction. Debt is very hard to pay back. Debt it should be scary to you. And there was something very pure, whether it was 5 or 10 years ago, pre-pandemic, when debt was not available to people. And maybe we're going back to that stage, but being able to get debt is not a good thing.
What do you say about people that, and these are people that are wired different, but we talked about it in an episode about Cameron Mitchell. Like, I know a couple operators that use that. I feel like it really fuels them and motivates them, whether it be investors and doing that, and this is a rare operator. I would tell you, for the majority of operators, great advice. But you have those outliers too that are actually fueled by some of that, that motivates them to continue to do good. And
sure.
Is there any place for that?
Well, I'll put it in two separate buckets. The financial mistake of taking a merchant cash advance, using credit cards to finance your operation.
Gotcha.
Being
okay.
undercapitalized.
Understood. Gotcha.
Paying rent with debt versus paying it out of your operation. Okay. So I very much appreciate a well-structured deal where I don't have to own 100% of something, and I can bring on partners, and this is the payback and how it works. But a great thing with like bringing on a partner and say, all right, someone's going to invest $100,000. We're going to treat it as a debt equity mix. They're going to own 20% of the business, but we're going to pay back that $100,000 first, and we're going to pay it back out of a percentage of the gross revenue or net revenue, whatever the formula you figure out. That is very sustainable.
Okay, gotcha.
Versus, all right, we're going to take a merchant cash advance for $50,000. We're going to pay back $150,000 over the next 12 months. It's like, that seems expensive.
Right. Okay.
So
gotcha.
there's a lot of mixed opinions out there. Good bet and debt, or good debt and bad debt.
Right.
Yeah, it's all on how you structure it.
But we talked earlier in all the time about ego, right?
Yeah.
And would you argue that ego is probably what gets you into that problem with a lot of this stuff? It's the desire to grow when you're in no position to grow, or it's the taking on debt when your back's so firmly pressed against the wall that you don't have a chance, but you have that last Hail Mary. Mm-hmm. Both those situations seem very bad to me.
Well, and sometimes it's just not paying for the extravagant vacation out of the company. Like, don't take the extravagant vacation. Again, when your company,
but it's an R&D trip. They have to have the private chef.
Well, I knew it was an R&D trip. Yeah. But when your company, only produces so much net revenue, you can't spend more than that. You're deficit financing this business, and it's going to be a problem, and it's going to catch up with you, because then your company that's producing 10% net revenue, the service on the debt is almost all of that, or it's half of it, or whatever it is of it. Now you don't have money for you.
Right.
Is it in doing what you're doing, being an acquisitions attorney, would you wish people would just sell sooner sometimes? Like, just come to that realization where it's like, okay, look, like, I see what's on the horizon. Rather than the last ditch efforts, I should just sell now.
Yeah.
I think it depends.
Yeah. I always think people should sell sooner. It is such an emotional,
of course,
hurdle to sell.
Well, you're admitting defeat to a degree, right?
Well, not you're admitting defeat necessarily, because sometimes it's just you're getting to the point of your personal life cycle.
Yeah.
All right, I'm at the point where I need to sell this business. What does the next 5 years look like? The age-old example of, all right, I'm going to sell this restaurant. I make $200,000 a year off this restaurant, and I want to sell it for $500,000, but really the best I can get right now, because the financials don't look good, but this is what I actually make. I'm going to sell it for $300,000 and finance it over 3 years with the seller. The seller thinks, all right, well, all I have to do is work in the next 18 months and I could make $300,000. That's not, like, that's what the seller always thinks. But you're like, all right, but you got a bad back. Do you want to see your granddaughter's recital? Do you want to be able to?
Yeah, for sure.
Do you like? Again, it often becomes about the money as I want to get a good deal, and sometimes,
there's other realities.
Oftentimes, the reality is I should have sold sooner.
Right.
Yeah. And I guess what I'm referring to is in my line of work that I've approached some deals, and you've probably even seen them before, but it's like everything looks good, and then you realize how many liens are against the property.
Yeah.
You know, it's like, damn, like you're not getting out of this. Like,
No, there's skeletons.
Oh,
Yeah.
that goes back to the debt thing. I've seen that in so many transactions that the seller ends up with nothing.
Yeah.
And not because they didn't sell for a high number, is that they've already taken the money.
Yeah.
yeah.
That money's already owed.
Yeah. No, it's all right. We owe $500,000. We're going to sell it for $500,000. And I got to bring money to closing. It's no different than a house, you know.
Yeah.
You're like, well, maybe I shouldn't have overpaid for it or whatever. And it's like, yeah, no, it's or took out the second mortgage. Number 3, know your numbers. Not knowing your numbers is the biggest mistake. You got to review your P&L monthly. You got to track your prime costs. And I'm not going to do a heavy beat on this because this is all we talk about all the time. But that is one of the biggest mistakes of not knowing your numbers.
I can tell you, we still review prime costs every single week without fail.
Yeah.
It's not negotiable.
And if you're struggling, review that stuff daily.
Yeah.
Like that, you got to be on top of that. Number 4, I've been seeing this a lot lately. And again, maybe that's a product of the pandemic or when times were good, but buying toys you don't need is the 4th mistake. Only buy what you truly need. I saw this really cool post, and it was for my personal life. We all get addicted to just hitting Amazon and like this stuff showing up at your house. Those are just boxes of cash. And then you look around your house and you have all this clutter. And I have this, wet saw, and I have this thing or this drill, and like I have this.
This sounds pretty personal.
Yeah, no, but it is. But it's like it's just cash that like is out there. And it's like I don't need it. Now I have to maintain it. Now I have to store it. Now I have to deal with it. Like,
so we shouldn't deliver our food in Lamborghinis.
Yes, exactly. I would say no Lamborghinis for delivery vehicles. But what things in your restaurant are you doing that with? Whether it's
what's the next shiny thing? Like you get presented with something. You're like, oh, this would be cool.
The new sous vide thing or the new whatever.
And now you're talking something different though, because there's clear ROI on those things.
No, but
maybe not always.
Well, ROI is always a maybe, right?
Yeah.
Like
no. But is something cool to have? And I'll give you a better example. This is so prevalent on the tech side. So you got this plugin and you got this thing, and so now you're spending $300 a month on 5 different subscriptions, and you're not using any of them.
Yeah.
Or you've never implemented them, or
right.
you get so excited to buy the shiny new toy, and then you're not using it.
Yeah.
So those are the sorts of things.
Well, and this bleeds into the previous one on that, like the subscription-based stuff, because that's everywhere in your personal life and your business. Yeah. If you don't know your numbers, if you're not reviewing,
yeah, for sure.
No. Yeah,
they have apps now that manage your subscriptions for you. That's the culture right.
That's wild.
Which is like genius. But I mean,
do we really need a middleman?
Exactly. Yeah.
Well, you do, because you're not going through your bank statement.
Right. So need is the operative term there.
Yeah. And I will say, as far as how tricky things are, some of the things that you're spending money on now on your phone and maybe I'm just beating up on the subscription world here and the tech side. But it's not very clear what it's actually for. So PayPal and
Apple,
and Apple Pay. Yeah. It's not very clear as what it was for.
What do you mean not very clear? It's unclear.
Yeah.
Yeah. Unless you know the exact dollar amount that you're spending on that certain service,
well,
you have no idea what it is.
Is this my Netflix or is this?
I have no idea.
Is this my Microsoft 365 or like what is it? So it's like, yikes! That's scary to me as far as.
Oh, I did an audit on that. My credit card, like maybe 6 months ago.
Mm-hmm.
Baffling.
I did it year 1, and we had like 2 of multiple things. It was like Noah's Ark of subscriptions. Like my son had one, I had one, then I would have one. My wife would have one. It's like,
but it's only $8.
Yeah,
exactly. Yeah,
correct. For the last 3 years, times 2. Like, right. So this stuff really adds up. Number 5, paying bills and taxes late. Make a calendar of when stuff is due. And I talked about this in past episodes. The contract calendar is so key. Making sure again, it's not a surprise, most of these bills, be very aware of when they're due. But like the tax bill, the county has that every year. The food license. Do you know when your food license is due? You know, it's not a surprise, but I know exactly what it costs if you pay it late.
Yeah.
It's an extra 20%.
Yeah.
So how many of those things are you doing that you're paying your bills late that it's eating into your net income? Because that is just like setting money on fire. So make a contract calendar, schedule the bills, look at them weekly. And that is one thing I think that not enough people do when it goes back to looking at the numbers. All right, what is our payables? And what is our payables as of each item? And is there anything that's causing creep? So are your terms with your vendor 30 days, but you're always running 60?
Right.
Well, you got 30 days worth of payables there that, you know, even when your company's doing good and you're taking that extravagant vacation and you think you're rich, you're not, because your bank account's lying to you.
Right. And well, and this is I talk to people all the time about, like, if you have to pull up your bank account, then grab a calculator to figure out how much money you've got.
Yeah.
You're probably, you could tighten things up a little bit. You know what I mean? Because
Correct.
again, you're purchasing food from a distributor, you're selling it probably within 7 days. If you've got more than 14 days, like, and then go back, you want to sell your restaurant?
Oh,
Now you got to back that back out
Oh,
of,
yeah.
of the sell price that you're not even thinking about. You know, so
yeah. I just helped a guy close a restaurant recently, and it's like all these bills keep on coming out. I was like,
yeah.
what the? Like, I was like, this is difficult. Like,
Yeah.
you know, like we got to pay this and you got to pay this. And well, it's, you know, it's, whether it's labor or what have you, like there's all these things that are rolling bills.
Yeah.
And you better have the money in there.
No question.
So that's number 5, paying bills and taxes late. Number 6, chasing profit and forgetting people. This goes, I think, back to so many episodes that we
What a
have.
line that is.
Yeah, but think about that. Like you just abuse people, and you pay them the bare minimum, and then you got turnover, and you got all the issues that go with that, versus having an appropriate business model, pricing your menu appropriately, where you're able to pay the person what they're worth and reward them throughout the year. So are you buying swag for the employees? Are you giving spot bonuses? Are you showing signs of appreciation when someone has a child and you buy them, a nice stroller set or whatever it is, or, you know, they bought their first house, or they, a parent passes away and you're sending them like, hey, you know, take 2 weeks off, you know, and I'm going to pay you.
Right.
But, you know, those are the sorts of things that, you know, if you're totally oblivious to the human element of your restaurant and only are serving profit, it can be detrimental.
Yeah, there's a deteriorating effect on really good employees, that the more they work, the harder they work for busy nights, the organization makes more money and they don't, right? Because they're salaried employees. And one of the best mechanisms I've seen is the profit share. And you be very careful about how you structure it, but that way, at least if they're working harder, they know they get paid more.
Yeah.
I can tell you firsthand how effective that is. And when you talk to your key people at the end of a really busy night, the tone in their voice, even though they got their heads kicked in for 12 hours, they're understaffed and up against unfair catering and all this jazz, they're actually excited because they know what's coming next month.
Yep.
They got stake in the game.
Well, and also I think it's important to note that this is an and, not an or.
Correct.
You know what I mean? So if you just flip those things and say people first, financials next, or, you know, I think we talked about culturally and fiscally responsible. You know what I mean? Because you could be all in on the people and mess up the first 5 things. You don't have a business to have culture for those people.
Right.
You know what I mean? So it's an and, not an or.
Yeah.
And mistake number 6, chasing profit and forgetting people. It is a financial mistake. I know it's people oriented, but like it is 100% a financial mistake, and it is so
more like a series of financial mistakes.
Yeah, and it's so financially costly. So that's my 6 mistakes. That's how to fix them. I think it's so important that as operators, as the industry gets more and more difficult, that you focus on these things and that you become a student of the game. And I think there's a lot of noise out there as to what the mistakes are, but but I really wanted to put in there how to fix these things
Yeah.
because that is important on how you
course.
become a better operator.
Yeah,
I think people got to get in the habit of understanding the discipline behind the money management, right? Like the money in the business bank account should be a tool to grow more business.
Yeah.
It's not money until it hits your bank account. And I think you have to have a certain detachment from that and understand those are not my dollars, that's the business's dollars. And that's wildly different than what you have. The more you leave in the business, typically the better your business is going to do.
Yeah. And you'll see in the show notes, I talk about retained earnings and some other financial things that you really need to understand and execute on, because if you're not looking at the financials, the bank statement's going to lie to you. And if you're just looking at the financials and not the bank, your cash flow can be an issue.
Yeah.
So really be a student of the game and focus on the financials. You need to understand them.
Yeah.
One more piece on the back end of what I said.
Yeah.
You end up, if you take too much money, you end up trying to save your way to wealth.
Yep.
And I think that ties in with a couple of the notions you said there. And that's a downward spiral right there, buddy.
It's game over. The moment you try to save your way to profitability or try to take a merchant cash advance, you might as well just shut the doors.
And the best operators I've seen and the most successful are the ones who throw money at it as opposed to taking money from it.
Yep.
Period.
No.
Yeah.
Throw money at your staff, make the hospitality better, make the food better. Trying to cut corners. When you change a key ingredient, the customer knows.
Yeah. No question. So no, this was awesome. Thanks, Brian, for putting this together. And thanks for putting the fixes together. Because you talk about the mistakes all day, but that's important. So check that out in the show notes. Check it out on restauranttopia.com. And we'll see you next time.
I like that voice.
Yeah, no, thank you, everybody.
Gentlemen, it's been real.